Good evening, everybody. Thanks for joining us. This week, I want to cover a technical indicator that you may not have heard of and you may not have used within your trading strategy, the Coppock Curve Indicator. Now, basically, it's available on the Plus500 system, so it's readily available to use for you. And we're going to take a look at the types of signals, the timeframes that we can use the indicator in, and how we can apply it to trading various markets. Now, the example that we're going to look at is the US 500 index, but as with all technical indicators, this can be applied to any market that you're trading, that you're analyzing. It's not exclusively for the equity markets and can be used in any asset class. So that said, the Coppock curve and indicator was developed by Edwin Coppock, and he devised the indicator for long-term stock market investors. And this was developed in the 50s and basically was designed to highlight upturns within the market that were likely to be a long-term advance within the stock indices and within the stock market at that particular time. Now, the indicator, as I would say, was designed to actually use on a monthly timescale. And going over the formula very quickly, it's the sum of a 14-month rate of change and a 12-month rate of change smoothed by a 10-period weighting moving average. So the indicator is actually just one line and it's below price action, and we can look at that in relation to price activity and how we can apply that to trading ideas. Now, the reason why Coppock arrived at these periods is that he was speaking to his local priest and asked what was the typical time period for anybody to get over a bereavement. And his priest said between 11 to 14 months. And this is why Coppock used this time frame, because he was basically thinking along the lines that if anybody had lost money within a bear market, it would normally take about 11 to 14 months to overcome that loss and to actually view the market and be able to trade effectively once more. So this is why we've arrived at the 14-month and 11-month period, and then the smoothing factor as well. Now, the buy signal is generated when the indicator turns up from a trough, and it is trend following. And because it's based on averages, by its very nature, it's not designed to highlight market bottoms. It is designed to highlight when we see a turning point within the market that reflects a sustainable move within the direction of the turn. Now, Coppock wasn't necessarily interested in sell signals. He was only interested in buy signals. But as we'll see within the examples that we're looking at, you can use the downturn in the indicator to highlight either consolidation or more extended corrective periods within price action. Now, variations of the Coppock indicator have been developed over the years, and this has basically been to shorten the time period and to incorporate sell signals. So while we're going to look at the indicator within the original 14, 11, and 10 periods, which is the default setting within the Plus500 charting system, and that stays constant, what we can actually change is the time period that we're looking at, and we can see that while we do go shorter term, it becomes slightly less reliable when we're looking at intraday charts, but even then, we can see some interesting turning points within the market. So let's have a look at the US 500 index with the Coppock indicator below, and this is the blue line below. Now, effectively, what we're looking for is turn-ups within the indicator to highlight turning points within the index itself. Now, this is a monthly chart. Now, this is what Coppock originally was applying his indicator to. And so this is a very long-term system. So basically, we're looking at when the indicator turns up to highlight positive periods, which is reflected within green, and when the indicator turns down to reflect the risk of consolidation or even bear phases within the market. And you'll notice that the downturns within the indicator are less reliable than the positive signals. So obviously, if you're trading equity markets and stocks from a very long-term perspective, using it on a monthly basis can highlight some interesting signals. But it may well be that we can use this more even if we're trading from a shorter term perspective, because part of the battle of actually initiating trades is knowing where the long-term directional risks are, and we can build that within our strategy. So when the Coppock indicator is rising, then we have a positive tone, a positive trend within price action. When it's falling, then we won't necessarily want to be involved on the long side because we're looking at the risk of overextended conditions, consolidation, and even, as we can see within the latest signal, the bear phase on a monthly basis, which is incorporated and highlighted the vast majority of the recent downside move. So that's the monthly perspective. That's a very long-term outlook for the market. Let's have a look at it on a weekly basis and try and highlight the types of signals and whether they're reliable from a weekly perspective. And using exactly the same signals, when the indicator's rising, we're in a positive tone and we highlight that in green. And when the indicator's falling and we're in corrective tones, then we can highlight that within pink. And we can see that there are, again, even though we're looking at a shorter term perspective than Coppock originally developed the indicator for, we're looking at a weekly perspective, we can see that, again, we have some reliable signals in terms of highlighting the directional trend. Now, if the market is overextended, we will run into these periods where the Coppock consolidates, enters a decline period, and the market continues to move higher. But we then start to re-establish more positive themes as we go into more negative outlooks within the corrective phase that we've just entered. So again, we can use this to build structure from a shorter term perspective. So we should always know what the longer term trending condition of the market is, and we can develop that and build that into our own trading strategy. So again, the Coppock indicator can be very useful in highlighting those trending conditions. Okay, so let's go really short term. Let's look at a 15-minute chart and just see whether or not we can actually build this in to a 15-minute trading strategy. Well, I've said already that the shorter term we go, the slightly less reliable the signals become. But even then, we can see by using the same setup that when the Coppock indicator on a 15-minute basis turns higher, we do see price strength beginning to materialize. And when it turns lower, we see corrective phases within this shorter term outlook. And that can highlight at least periods to not be active within the market if we're not necessarily wanting to go short, but to take profit, stand aside, and wait for the next turn up within the indicator to give us a fresh buy signal. So even though the indicator itself was developed from a long-term perspective, when we apply it to short-term 15-minute charts, it still gives us some fairly reliable and interesting signals of the positive and negative trending conditions of the market. So I think the Coppock indicator is very useful no matter what time frame you're looking at, no matter what markets you're trading, and could well be added to your suite of technical tools to highlight where the trending conditions are and where the directional risks are beginning to materialize.